Hello, everyone. It's Larry Kotlikoff back with Economics Matters. I'm delighted to have my very good friend George Hoguet with us today. George, I've known forever. He's a private investor and CEO of Chesham Investments, LLC. He's also consults to various institutional investment committees. For many years, he led the active emerging markets institutional equity investment team and served as global investment strategist at State Street Global Advisors. State Street Global Advisors, one of the largest investment managers in the world. So let me just kind of emphasize this. Getting a job at State Street is no minor deal. Being a big deal at State Street is a very big deal. George was a very big deal at State Street for a very long time. And then he switched into his own enterprise at Chesham Investments. But at State Street, he worked with some of the world's largest institutional investors, including central banks and sovereign wealth funds. That's also a very big deal. He spent the first part of his career in investment banking at Citicorp, investment bank, and then at Bankers Trust Company. And he worked on oil and gas mergers and acquisitions and supervised the bank's business in Africa. From 1981 through 1984, he served at the US Treasury Department. We were both down in Washington at the same time, but we didn't actually connect. We didn't meet each other at that point, but he was a big deal. Before it became a big deal, he was a big deal at the US Treasury. He served first as U.S. alternate executive. Well, I guess you were first alternate executive director at the World Bank. So first is at the World Bank, and then he goes over to the Treasury as Principal Deputy Assistant Secretary of the Treasury for International Affairs. So George has worked in government. He's worked in international organizations. He's worked in the private sector. And he's worked at the very top, highest levels. Now, maybe this has something to do with his personality, but also he's extremely well trained. He's a graduate of Harvard College and Harvard Business School. He holds an MA in economics from Boston University, where you know I'm at. And he earned the Chartered Financial Analyst CFA designation, and is also a qualified financial risk manager. That's an FRM designation. So George, delighted to have you. And we're going to kind of turn the tables in this podcast today. George decided, having listened to me interviewing so many people, I think I've done maybe 60, 65 podcasts since I started Economics Matters, the newsletter and the podcast. George decided that he wanted to hear me talk rather than me ask questions. So he decided he wanted to interview me. So this is kind of a different turn the table situation where George is going to hit me with questions and I'm going to try and answer them. But we're also going to get George's opinion on things because it's going to be a two-sided conversation. So George, fire away. Thanks for having me.
Larry, thank you very much for that very kind introduction. And I do just want to point out to our listeners your extraordinary intellectual and civic engagement over the years and the contributions that you've made as a researcher, having published more than 100 academic papers, and of course, a well-regarded textbook in macroeconomics, as an educator, having built up BU's economics department, as a consultant and public intellectual, having testified more than 19 times in front of the Congress of the United States. You mentioned your podcast, which I and others, I think, have found to be extremely topical and informative. But also, Larry, as a political change agent, having run for president and outlined a very comprehensive plan to address so many of the structural problems that face our economy. And finally, as a businessman and financial planner, having developed Maxify Planner, which is the very best personal financial planning software available in the market, and helps people really navigate the complexity of the Social Security system. And what really resonates with me, and I think many others, is a phrase on your website, which is that research, theoretical and empirical, is the basis of personal, national, and international economics. So it's great to have an opportunity to chat. And let's just jump in right away on the topic of fiscal dynamics in the United States, the fiscal gap, and the long-term outlook. So as is well known, I've got a full employment deficit now of about 5.4%, primary deficit of 3.8%, debt to GDP, according to CBO, rising to about 145% in the next 20 years. And you've laid out a comprehensive plan, the Purple Plan, talking about a business cash flow tax, increase in FICA tax, and other measures. And I was interested in your writings when you talked about some of the problems of the definition of debt and how we define debt more broadly speaking. But let's start out by discussing how acute you think this problem is. So two prominent economists wrote in Foreign Affairs in 2019, "Who's afraid of deficits?" And the basic argument was that when real interest rates are low, if R is less than G, we really shouldn't worry that much, because as long as we're borrowing to improve our productive stock and develop our human capital, that this issue is not as palpable and urgent as others make it out. So I'd just be interested in your general thoughts on that.
Okay, well, first of all, again, George, thanks so much for joining me and thinking up this idea of asking me questions about my views. I think the U.S. is in terrible long-term fiscal shape, much worse than the politicians and almost every economist is portraying. Part of the reason is that we've hidden I say we all know that official debt is very high, but we don't realize that unofficial debt that's been put off the books, is much higher than the official debt. So that's really the reason why things are much worse than most people realize. Even members of Congress, they're not really understanding that something that's off the books, it can be just as real in terms of an obligation than something that's on the books. If you think about Social Security's unfunded liability, which the trustees report in March 31st, 2023, came out and said that it's 65.9 trillion. That's more than twice the official debt. It's about at least the debt is in the hands of the public, and it's about 2 years of GDP. So just Social Security has got a liability that makes our official debt, look small. Now, what is the unfunded liability of Social Security? Well, you take all the projected outlays as projected by the Social Security actuaries, and you subtract all the projected receipts, all the FICA, payroll tax receipts, as well as the trust fund, which has a present value today. It's not huge, but you include that, so you treat it as something real. Some people argue over whether it's real or not, but they incorporate it for sure. And 65.9 trillion, the $66 trillion. Again, US GDP is around 24 trillion. So I guess we're talking about, it's more than twice GDP. Now, if you do this for the entire country, you have a fiscal gap that is the difference between all the projected outlays, not just for Social Security, but every expenditure we can think about, defense spending, welfare benefits, healthcare benefits like Medicare and Medicaid, uh, defense spending, infrastructure spending. The whole path of outlays has to be covered in present value by the path of receipts and taxes from all sources. And in present value, that difference is enormous. And let me just try and put it in these terms. It's about 8% of GDP every year. 8% of GDP every year would be enough to close the fiscal gap. And that would require almost a 50% hike in every single revenue source. So think about your income taxes, George. You'd have to face 50% higher income taxes, 50% higher FICA taxes, 50% higher excise taxes, uh, every federal excise taxes, every state taxes 50% higher. So, and how is it that we have so much off the books that we're missing? Well, it's pretty easy to put things off the books. I can take some money from you, George. I'm Uncle Sam, and I say, let me take let's say $10,000 from you today and promise to pay it back with interest in the future, maybe in 10 years. Now, did I just borrow 10,000 and so did I sell you a bond, an IOU, and take back 10,000 and then have on the books an official obligation to pay 10,000 back to you with interest in the future? That's one set of words. I could also have said, hey, I'm taxing you 10,000 today, George, and in the future I'm going to make a transfer payment equal to the 10,000 plus interest. If I use those words, I put it off the books because the obligation to pay you back the 10,000 that I took from you now that I promised to pay you in the future with interest, that's not valued as official liabilities. That's off the books. So really, the official debt is just a word game. And we're getting mixed up in our language. And it's really no different from, relativity in physics, where we don't, we know that the equations of physics do not define time and distance. We know that the perspective, how you measure those things depends on your frame of reference, your language. If you're going through space at this speed, at this direction, you're going to get one measure of the time right now. If you're going in that direction, a different speed, you'll get a different measure. And those frames of reference are really labeling conventions or languages. And here, it's no different. How we label, how we talk about our fiscal policy matters. The real thing is I'm taking 10K from you and I'm going to give it back to you in the future. I could also be taking 10K from you and not giving it back, or I could be giving you far more than 10K plus interest. That's the real policy. And we need to have a measure that's independent of how we describe it, how we label it. And that's the fiscal gap measure. And that under that measure, which I started working on, and also a related measurement called generational accounting, which looks at how much of this fiscal gap, how big of a fiscal gap, how big of a burden does the fiscal gap impose on our kids? I started working on that with Alan Auerbach and a former grad student, Jagdish Gokhale, who's been a Cato of late. We started working on that back in 1989. And this is the way economics says we need to measure these problems. And we showed that given the trajectory we're on back then in 1989, that we were basically impoverishing our children. We were putting such a fiscal burden on our kids that they were not going to be able to maintain their living standard like we have. The American dream was being killed. And we did this analysis for countries all over the world. And it's still being done by different countries, and the European Union is doing a version of this every 3 years for every member of the European Union. We don't do it at all in the US. We just keep everything off the books so we can have congressmen and women and avoid the truth. And anyway, so we have a terrible problem, and we need to come up with radical policies to fix it. I mean, think about Social Security. Nikki Haley, who I admire a lot, is running for president. She's the only one who's really talking about fixing Social Security, which we know in 10 years is going to run cash flow negative and not be able to cover benefits. So she's saying, well, let's raise the retirement age for younger people. As they get older, they're going to have to start their Social Security benefits later. And well, that's probably a good part of a proposal to fix Social Security, but it's peanuts in terms of the $65.9 trillion fiscal gap that Social Security faces. So we have to be addressing these issues much more fundamentally, because what the politicians are proposing is just another form of kick the can down the road. Let's come up with enough money to shore up the short-term cash flow deficit problem. That might also involve even more borrowing off the books, and then let somebody else handle the issue. This is a prescription for the end of the country. I mean, we're falling behind. If you look at what's going on with our military, China is projected to have basically twice the size of its navy and at the mid-century than we are. We can't keep up because we're running out of money. We can't do basic research because we're running out of money. So it's not just in the future that this is coming. We see it right now that Congress doesn't have the money it needs to cover what the richest country in the world should be doing.
So, Larry, I recently read a analysis by the Aspen Economic Security Group, Karen Dinan, paper, and she points out that federal tax revenues as a percent of GDP on average are around 17.5%. They fluctuate around that average, but however one gets there, do you think ultimately that we do need a significant increase and immediate increase in the federal tax revenues? Do you think that that's a inevitable part of the solution here?
Well, we need either. I mean, there are some economists, just get back to your first question, who think we can engage in kind of magic, just keep borrowing. And because the interest rate, at least it was low when they were talking about doing this, and we're talking about people like Olivia Blanchard, former IMF chief economist, and Lawrence Summer, former Treasury Secretary. They think there's a free game by just borrowing more and more and just paying at a low interest. Of course, the interest rate is no longer low in either nominal or real terms. And that analysis was flawed to begin with. Blanchard delivered the presidential address to the American Economic Association 2019, and he basically said deficits are free, or at least he raised the question. He said deficits may be free, put it that way. And if you look carefully at the model that he presented, it's really got some misinterpretation. He kind of misinterpreted his own model, and the reason that running deficits in his model had nothing to do with the return on interest, the payment you had to make, the R on the debt versus the G, the growth rate of the economy. You couldn't kind of outgrow the debt. It was really due to the fact that the interest rate was low because there was a lot of risk in his model, and people were nervous, and government bonds are safe. So when times get dangerous, or if you set up a model where there's a lot of risk, then you suppress the interest rate goes down. It has nothing to do with the fundamentals of the economy, which are the productivity of capital, which is far beyond the growth rate, the true R, if you want to call it that, the right R to look at. And so once you say, let's think about a government policy that appropriately deals with the risk, then the entire possibility of trying to make everybody else buy running a Ponzi scheme goes away. In other words, what his model is about is ensuring across generations, not about running a sustainable Ponzi scheme. And he just didn't understand what he was writing. But to get back to your question, do we need to raise taxes or cut spending? Absolutely. It's kind of black. It's black and white. This is what economists specialize in, is making sure people understand budget constraints, whether it's household or government or uh, uh, country-wide budget constraints. We have to, national budget constraints, we have to realize that we can't spend more than we've got. And the problem, though, with raising taxes is our tax system is so screwed up that we have over half of the country, regardless of whether you look at the poor or the middle class or the rich, in marginal tax brackets. When you put everything together, so for the rich, it's, and I'm not talking about the super rich who have a great way to avoid taxes we could get to, but pretty rich people, not super rich, they have to face 37% federal marginal tax on working. Then there's a state marginal tax. Then there's sales taxes, all of which reduce the incentive to work. And you have some people in the 70% bracket, not the, we're not to talk about the 50% bracket, but 70% bracket. We've got the median's around 50% for everybody, but then if you look at the poor, we have probably a third of the poor are in marginal tax brackets above 60, 65%. Some are in marginal tax brackets of 20,000%, based on recent work I've done that you can look at kotlikoff.net with Alan Auerbach and other co-authors. What's going on here is that if I'm poor and let's say I'm earning the minimum wage, I'm getting food stamps, housing support, Medicaid for myself, Medicaid for my kid. Let's say and then I may also be getting some TANF, which is welfare benefits. And as I earn more money, I start losing these benefits. And if I earn more money, I could lose, if I earn an extra $10,000, I could go over a threshold beyond which I lose my Medicaid for my kids. That could cost me $10,000 just there. And that's how you can get super high marginal tax. So what we're doing is we've set up a fiscal system, a tax system that is locking the poor into poverty because we've got so many of them in such super high marginal tax brackets. And then we've got people at other levels of earnings who are also disencouraged from working. So what we need is a fundamental, when I said we need to fundamentally fix things, we need a fundamental reform of Social Security that basically grandfathers this old system and puts younger people into something that's fully funded and is sensible and is progressive, but is not, is not adding an extra 12.4% tax to their marginal tax bracket. And for the tax system, we need to go to much more simplified taxes, like a negative income tax that would be different for single people with kids and married people with kids, or consumption tax, broad-based consumption taxes, plus a progressive cash flow tax. I know I'm kind of saying things that people may not be fully familiar with but we economists have been studying ways to get more revenue with less work disincentives. So we need to do that. And on the spending side, we need some major reform, not just the Social Security, but on the healthcare. We're spending as a country 18% of GDP on healthcare. We're getting 21st level results in terms of the ranking of healthcare outcomes across different countries. Sweden spends 11% of GDP. We're 18%. Sweden's 11%. They're getting fourth best results. We're getting 21st best results. So why don't we just do what Sweden does? Okay, why don't we just adopt their plan? Or I propose with other economists and George Halverson is a former CEO of Kaiser Permanente, the Better Way plan, healthcare plan, which is basically do Medicare for all, but it's the Medicare Part C version of Medicare with some modifications. So it's a Republican version of Medicare where you have competition, but it's very strict so that these companies can't cherry pick on the public and they can't supply. We want to try and make healthcare a uniform product just like wheat, so that there's super competition. When you have a homogeneous product, and when you tell healthcare companies they have to provide exactly the same thing throughout the country, and then they can compete on, and then everybody knows exactly what they're getting. And it's not that this healthcare company says, promises you X and then actually doesn't provide it. Uh, and then you also have the ability to leave and switch to a different company every year. That's where you get competition. That's the kind of thing that's going on in Sweden, these other countries, competition. So we can get that 18% of GDP down to 11%. That can save the country right there. So if we did nothing else but had a presidential candidate who implemented fundamental healthcare reform, universal health insurance that was done right, not Obamacare and Medicare and Medicaid and employer-based care. We have a balkanized system. We're basically shooting ourselves in the head. We have the ability to fix things, but we're not doing it.
So unfortunately, tax policy is path dependent. I remember the Greece crisis, Eurozone crisis, and Juncker, who was head of the European Union, said, "We all know what to do. We just can't get reelected after we've done it." So I guess my question is, politically speaking, we're going to have to deal in some sort of incremental way. And I happened to stumble across a very interesting page on the CBO's website, which is called Budget Options. And it lists all these potential revenue enhancement measures, things like getting rid of the carried interest for private equity, increasing the FICA tax, taxing employer contributions to healthcare. And just looking at that list, it really seems to me that the biggest payoffs are frankly in increasing the tax rates, that other things seem fairly modest. So I'm just wondering whether intellectually it's really possible to come to the conclusion that we can't, that we're able to raise more revenue without raising tax rates one way or another.
Well, yeah, I think that most of what needs to be done is to cut spending intelligently in a way that is not devastating to anybody. And that, I mean, think about reforming Social Security in a way that grandfathers the old system, pays off people's accrued liabilities, what they've earned under the old system, but gives younger people a new system that's very similar to the Singapore system.
Right.
They contribute into a provident fund, and they know the money's right there. Their money, it's invested in all the securities in the world with the government guarantee, and there's matching contributions on behalf of the poor, the disabled, the unemployed, and then you get the money out in the form of an annuity that continues until you die, and it's inflation adjusted. All that is in my personal security account proposal. Wall Street makes not a penny, not a single penny from this proposal. So that would give young people something they don't currently have, which is right now they have a ticket to a disaster from Social Security. And this would give them, this would say, look, well, what you thought you were going to get from Social Security, you're not going to get. So you're going to get some pain here. This is not free. And you're going to have to contribute 10% of your pay, split between, it's going to go half into your account and half into your spouse or partner's account, legal partner's account. And, but it's yours, and nobody's going to screw around with it. We're going to get out from under an 88-year-old system that was built piecemeal. And this is something you can count on because it's fully funded and it's not a generational ripoff. Okay. That to me is, and that would eliminate a 12.4%. Well, no, we'd have to keep the payroll tax in place for a while, and it would come down through time as we paid off the old liabilities. But that to me is, thinking out of the box, doing major reform. Now you're saying, well, do we have to do kind of piecemeal reform? I don't agree. I think that if you have a uh, presidential candidate who says, look, here's the actual situation, what we're in, and we have to do some things that are radical. We have to, because we can't continue this way. We can't continue spending 18% of GDP and then trying to have the biggest military in the world uh, and compete with Russia and China and North Korea just throwing up a missile yesterday, another ballistic missile. We have to be prepared, and therefore we can't afford to waste money. And that's what we're doing on the spending side. And on the tax side, we can't afford to tax people at the margin uh, in a way that gives them no incentive to work. We can't afford to lock poor people into poverty generation after generation. So they have no incentive to make sure their kids are well educated and get good jobs because they're going to lose more than they get and they make or lose so much from working that it just doesn't pay. We just can't afford this kind of policy and doing things. Think about Social Security. What they did in 1983 under the Greenspan Commission, when we were in the situation where the projection was that we are going to run out of money in the short term. What Greenspan did, and I wish you were alive to be on my podcast so we could talk about it. But what he did was he basically operated on a quarter of a tumor. We have a huge tumor. He decides to operate on maybe a third of the tumor, knowing that he only operated on a third, knowing that, here we are years later, I guess it's about 40 years later, and the tumor is not just, the 2/3 that he didn't operate on. It's much bigger than it was. It's about twice as big as it was before he went to work to fix things. And he proclaimed that he had fixed things with his political committee, the Greenspan Commission. It was all full of politicians, basically. And they did too little, too late. So that's what we're doing. That's why we're drifting towards Argentina's trajectory of going from the fifth highest per capita GDP country in 1920 to where it is today, where we have, it's basically a developing country again, emerging country. It had 85% of US per capita GDP in 2020. Today, it's 14%. This is a result of a century of bad government.
So, Larry, it appears in recent years, to put it mildly, that our ability to act proactively to address structural problems is diminished. I think it was Rahm Emanuel who said during the global financial crisis that a good crisis should never go to waste. And my instincts are to get the fundamental reform or even significant piecemeal reform that you've outlined, that it's going to take a major disruption, such as a disruption in the Treasury market or some other technical debt default through Congress, not raising the debt limit or whatever. Let me
just back real quick to that. We've had, the Great Recession was we had 17 major financial institutions collapse. We had unemployment go up to, 10% from much lower. That was a big enough shock, and we didn't get any fundamental reform. What we did is we had the Dodd-Frank bill basically just rebuilt the financial industry the way it was. And then Barney Frank goes off to work for Signature Bank, which is one of the ones who just failed based on the same kind of problems that led to the other failures. So there was nothing fundamental that happened. So big shocks aren't necessarily the answer. I mean, the salvation. I think what's
catalyst.
Salvation is actually having a conversation at the right level and having economists present fundamental ideas. So, we have a problem here of engineering. It's economic engineering. We have not a single economist with a PhD, not a single person with a PhD in economics in Congress. 535 members, not one of them has a PhD in economics. I don't know how many have a master's. I don't know how many actually were undergraduate majors. So they don't have the capacity, frankly, to think through major reforms because that's not in their wheelhouse. They're mostly lawyers or came from some business people. That's fine. There's nothing wrong with that. But but what we need is really major, reforms. I put out a book called You're Hired. It's on my website. It's a free download at kotlikoff.net, which is when I ran for president as a write-in candidate in 2016, it's my platform. It's right there. Any of these candidates could take it and say, hey, we're going to go with what economics says to do. And when I say economics, it's coming from me, but it's also coming from other economists in the sense, because I went around and talked to the top healthcare economists, the top fiscal economists, the top Social Security, the economists who had specialized in these areas and banking, to ask what should we do and what are their views. Now, I didn't accept everybody's views. Not everybody agrees, especially in the banking area. A lot of people have vested interest. If you're an economist, you've been consulting with major banks, you don't want to do anything that rocks the ship because it's going to rock your wallet, right? But this book does contain in bullet point length, each reform is about 8 to 10 bullet points, and it's crystal clear what to do. It's not complicated, any of these reforms, and we can just do it. So I do think I'm actually more optimistic that we can, if we can get somebody who really understands how difficult the situation is, a good politician, but then adopts what economists have to say and persuades the public this is what's needed, then we can get this possibly to work. Otherwise, we're going to be Argentina.
There's an old saying, the first law of economics is that resources are limited, and the first law of politics is forget the first law of economics. So I want to get to limited purpose banking, but before we do that, I'd like to just briefly touch on this Singapore-like idea of funding people's social security. And let me tell you a little story. I had a friend who ran the Pension Benefit Guarantee Corporation. And at that time, I was in business, and I went to him and I said, why don't you consider investing in emerging markets for a variety of reasons? Diversification, return enhancement, broader opportunity set. And he basically said, Congress won't let us do it. So under your plan, how do we avoid the politicization of investments? And let me just point out that now that in a number of states, Chinese companies can't purchase American farmland. So how do we deal with some of the political constraints on global investments when people are being told that their money is being invested in Germany or France or wherever it might be?
Well, I would hope that we would. So let me just go through the proposal, which is that it's called the Personal Security Account System. If you go to larrykotlikoff.substack.com, larrykotlikoff.substack.com, you can, first of all, get a free subscription to my newsletter and to this podcast if you don't have one already. You can also pay for a subscription if you want, but it's free. And then you'll see an article called the Personal Security Account System. And the way it would work would be this, that let's say, George, you're 45 and you have been contributing to Social Security and you have an earnings history. Well, we're going to do the reform, let's say, starting today. We fill zeros in your earnings record. So when you reach full retirement age, you can decide when to start your benefit. And it'll be based on that earnings history that has positive values up to age 45, zeros thereafter. You're going to get your full accrued benefit under the old system. But we're shutting down the old system at the margin because you're not accruing any additional benefits. Now, what do we do? What else do we do? Well, we keep the FICA tax in place to pay off these old benefits, these accrued benefits. And we'll be able to lower it a bit from 12.4 down probably to about 10. And then gradually through time, as we pay off these accrued benefits, have it go to zero. So that's the old system. Now, at the margin, you're going to have to contribute, you and your wife or partner, if you're legally partnered, would contribute 10% of your pay to your personal security account. And let's say I'm also 45, so you're putting in 10%, and it's before the money goes in, the money that you put in and this 10% of your wage and the 10% of your spouse's wage are combined and split in half. So half of that total contribution goes into your account, half goes into her or his account. And if you get divorced, you walk away with an equal size account. I mean, it's your account. Has nothing to do with your being married once it's in your account. So then the money, and if you're poor or unemployed or disabled, the government would make matching contributions to beef up your account, so you have enough to live off. Now all this money gets invested in, let's say it's just invested in the S&P index by my laptop. All this can be done on my single laptop with no involvement by Wall Street. I could program this up, believe me, and you could as well. It's not that difficult. And the reason it's not that difficult is everybody's invested in the same thing. So if we want to just restrict the investments to the U.S. financial market, and yeah, there be people who are arguing that we should not be including fossil fuel investments. Well, my view is we need to, there will be people, I think they'll get outvoted. I think we can at least agree that we should be investing in the S&P 500 as well as the U.S. bond market, government and corporate bonds and state and local bonds. So now you have a diversified portfolio, and then the government would guarantee that you get at least what you put in adjusted for inflation, that your account balance when you start having your funds along with everybody else in your age group. I'm in your age group, you're in my age group, our money's in this thing. When we reach 59, the government is going to start gradually over the next 10 years withdrawing, selling off our portfolio and buying inflation index bonds with it. So in effect, you've got a certain amount of inflation index bonds and I've got a certain amount. Could be different based on the size of what we accumulated, but we're going to be getting the same rate of return through time every year. Okay. Doesn't mean we're going to have the same balance. We'll have the same rate of return. And then now we've got these inflation index bonds that are going to be used to pay us annuities, pensions that begin at age 62. So by age 69, we will have been fully gotten out of this global index or this S&P fund and the U.S. market fund. Let's not call it just the S&P because it will include bonds. And by the way, the U.S. companies, about 40% of their income is coming from abroad. So there'll be a lot of international diversification, including even in LDCs, less developed countries, through just investing in U.S. companies, large and small scale companies that are listed. And then between 60, after age 69, we're getting these. Between 62 and 69, we start building up the receipt of these annuities. Their inflation index, they continue until we die. And that's a modern version of Social Security. That's what Chancellor Bismarck of Germany, who started Social Security to begin with in Germany in the 1880s, if he were here alive today, how would he set up Social Security? Would he do it the way we've got? Something that's unfunded, underfunded, that's running down that's got 2,728 rules in its handbook, hundreds of thousands of rules, 20,000 pages of rules if you print out its program operating manual system about the 2,720 rules, about the 12 benefits that they apply to. So the thing is beyond complex. I just wrote a book. I was just on 60 Minutes, co-author Terry Savage, with talking to Anderson Cooper of this book called Social Security Horror Stories. Everybody should pick it up for Christmas. And it's about the fact that Social Security is clawing back, we said in the book, 250,000 people, but actually, then the acting commissioner said they're clawing back 1 million people a year. And then it turns out that she was not properly informed. It's 2 million a year. People getting letters in the mailbox that say, hey, you owe us $50,000. Hey, you owe us $304,000. Hey, we're suing you. You're 6 years old. You've been getting the wrong benefit for the last, we've been overpaying you for the last year. Pay us back. And if you can't pay us back, your guardian who's been running your checking account, they're obligated to pay back. I mean, it's most horrific things going on inside Social Security. Not that we're opposed to Social Security, we're opposed to it terrorizing people, being financially abusive. So all of this is to say that we can fix things. We can make things. Other countries have reformed Social Security fundamentally. Sweden,
Right.
Chile, a whole variety of countries have done this.
And other countries have also, per IMF Article 4 reports, engaged in significant fiscal adjustments. Indeed, we did so, right, during the Clinton years, right, when we brought down our debt to GDP very significantly, almost paid off our debt. So, Larry, another idea that you've been very vocal about is this notion of limited purpose banking. And you've pointed out correctly that the US financial system, roughly every 15 years, appears to have a financial crisis of one sort or another. This might reflect in part the dynamism of new product creation by the financial system and the complexity of the products that are created. But your basic idea, as I understand it, is that we basically set up a series of specialty mutual funds, and which would invest in various asset classes, mortgages, consumer loans, and so forth. I had maybe you could say just a few words about that, but I did have a question about what this would mean for the monetary transmission mechanism and whether you think that might be changed by virtue of this proposal.
Okay, so just to give a little background, thanks for the question. I wrote a proposal called Limited Purpose Banking, and then I wrote a book about it called Jimmy Stewart is Dead, right around the time of the Great Recession, which has gotten a fair amount of attention. Whenever there's SVB, Silicon Valley Bank, went under, the next day Martin Wolf, the chief economics correspondent of Financial Times, starts writing about limited purpose banking. So major people have been thinking about this. I've had conversations with central bankers from Paul Volcker, on down over the years. So people take this seriously, this idea of an alternative way to run the banking system, and that's the shorthand for all the financial corporations. In a way, how to run the financial system so it can never fail again. Every 15 years, we have a recession that has the words panic in it, and it's connected to the financial panic that arises and then either causes the recession itself or makes the recession far worse. And the current system works like this. I'm a bank. I come to you or George, say, George, give me your money. I'll pay you back for sure, no matter what. I then invest it at risk. And then I tell you, George, you can come and grab it anytime. I give you back a checking account. It's a demand deposit. You can demand your money back. Or I might say, sell you a CD. You can demand that back after a certain number of months, or even sell you a bond. Might have a little bit longer term. But what I'm doing is I'm making promises I can't keep. I'm promising to repay no matter what, no matter whether my investments that I've made with your money have gone to zero. Okay. And then the government is saying, well, if you, the bank, if I can't repay, the government will repay up to a limit. And the problem is a couple. First of all, the limit is still pretty low, like $250,000 per checking account. And about of the $17 trillion of bank deposits, about 7 trillion are uninsured. So what we saw with the SVB, the Silicon Valley Bank run, was that in the course of a day, $42 billion were taken out of that bank and transferred to money market funds, mutual funds that are basically where the money is invested in a way where you actually see what you're investing in, and you own the investment in effect through the mutual fund. I'll get to that in a second. But anyway, Silicon Valley Bank goes down. A couple weeks later, or a couple days later, Signature Valley Bank chairman is one of the members of the board, not the chairman, Barney Frank. That goes down. We've had several other major banks go down, and we're sitting here with still the potential for a major run on these uninsured deposits that could kick off a run on the insured deposits, because the government is saying, well, we're not going to insure these uninsured deposits, especially if they're with small, medium-sized banks. But when push comes to shove, they'll have to say we are. But if everybody does what they do in Argentina, which is calls the government's bluff and goes for the money, then if the government were to try and print 17 trillion, and then if you're going for your uninsured deposit that's now been insured, and I've got let's say $100,000, I'm going to go get my money out because I realize the government doesn't have the wherewithal to print 17 trillion, to come up with 17 trillion bucks. And therefore there's going to be inflation if they try and make good on this. And therefore I need to get my money out to go buy some furniture at IKEA. So the problem is that we have the banks making promises they can't keep. And then on top of that, the government makes promises they can't keep. And you see this. So we have a system that's fundamentally unstable, that's fundamentally on a knife edge, both at the bank, at the private level and the government level, and is not fundamentally sustainable. And we're putting the entire country's economy at risk because the entire thing can melt down, as it has repeatedly in Argentina. So limited purpose banking, real quick, works like this. Rather than you're giving me your money and I say I'm going to pay it back for sure, I'm a bank or a credit union or a mortgage company or whatever. What I say is I'm a mutual fund, and you give me your money, I'm going to give you back shares to the mutual fund. And we have 10,000 mutual funds in our country already. And some of the money that the mutual funds are taking in are to invest in mortgages. Some are to invest in commercial paper. Some are to invest in the stock market. Some are to invest in foreign stocks. But the key thing is that if these investments go south, you, George, have shares that lose value. But you can't come to me and say, where's my money? Because I'm not making any guarantee. So
Right.
if all the financial companies, all the financial corporations are organized as mutual funds, equity finance mutual funds that have no debt, then they can never go bankrupt. So then you have a financial system that can never fail. And let me just say that the last thing I'll say here is that in 2008, when we had something like 400 banks failed, and 17 of the largest banks or financial institutions, including Fannie Mae and Freddie Mac and AIG, which was the largest insurance company at the time in the world, they all failed for the same reason. They were all leveraged. They all made promises they couldn't keep. They failed, and they would not have failed had they been limited purpose banks, which are mutual funds. Now, let me let you respond, and I know you want to ask about the monetary.
Well, I want to ask about. Let's take as a given the leverage and opacity issue and the fundamental structural issue of maturity transformation. The policy response, Basel III being, focus on capital, reduce leverage. But let's accept that the issues that you've highlighted still persist. It seems to me that one aspect of your proposal is that basically it's distributing the losses to the individual investors. So if I invest in a cash mutual fund and there are losses for whatever reason, the effect of breaking the buck is basically the NAV goes down of the assets of the fund, and my shares go down.
Think about a money market fund.
Right, right.
Money
But
market,
but but
yeah.
let's deal with the issue of monetary transmission. Banks are making loans and creating deposits. How does the money multiplier work, and basically the conduct of monetary policy? How is that impacted by your proposal, and does it become more complicated or structurally different?
Well, no, I would say everything becomes easier actually. The So first of all, you mentioned cash mutual funds. That's different from a money market mutual fund, and that's different from a stock mutual fund or a mortgage mutual
Right.
fund. And these mutual funds, some of these would be open-ended. Most of our mutual funds right now are open-ended, but a lot under this new system would be closed-end funds where I take in money in my mortgage fund, which is investing in mortgages in Providence, where I'm speaking to you from, where we live. Even though I commute to BU to teach. And I take in a certain amount of money, and at this date the window closes. It's just kind of like a racetrack bet. Everybody puts in their money, then I take the money and I invest in mortgages for people living in Providence. And if the mortgages, whatever money comes back to the fund is then paid back to you, the investor, but you can't come and get any money out at any date. You can't redeem your shares from me. But because we'd have a federal agency that was verifying these mortgages on a real-time basis, you'd be able to sell your shares on a secondary market. So we'd have something we don't have, which is, transparency in the system. We get rid of the opacity that underlies the current system, because as a bank, I take in money I invested, you don't get to know what I'm doing with it. That's what's going on in the current system. Now, the way the monetary system would work is you would have every mutual fund company would be issuing cash mutual funds where you give me some money, I give you back shares to it. But it's just a cash mutual fund, so it's holding only cash, basically parked with the Federal Reserve. So that's your transactions account. That was called narrow banking, that proposal to have cash mutual funds.
Right.
The economists of like Irving Fisher and Frank Knight in the 1930s proposed this, but limited purpose banking goes far beyond narrow banking. Narrow banking is a component of limited purpose banking, but we'd have every single financial corporation doing just one thing, which is issuing mutual funds that are 100% equity financed, with the government verifying everything about those mutual fund securities on a real-time basis. You might think that's a huge big deal, but that verification is happening already all the time. Think about getting a mortgage. You have to go to 5 different banks. If you go to 5 different banks, you have to have your house inspected by 5 different companies to get a mortgage, or you have to fill out the paperwork. This would be a whole lot simpler in terms of the verification process, and as I discussed in the book. But anyway, how does the government now increase the money supply? Well, it would the money multiplier would be 1, because there would be no banks who would then make issue loans, and then people would be able to kind of create loans out of thin air, and then have the people say, I give you a loan, and then you immediately deposit the loan in my check. I give you a loan by opening up a checking account for you. In effect, making money out of the blue. Okay, that's the current system. So here the government would have complete control over the money supply, which is something that Milton Friedman advocated. But then how would the government expand the money supply? Well, the government could, the Treasury, for example, the way they currently do it is through open market operations, as you well know. The Treasury sells bonds to a bank, maybe it's a Wall Street bank, and then the Fed basically prints money and buys up those bonds. So the Treasury sells you some bonds through this company on Wall Street. Your money goes to the Treasury. They go buy chicken for the president for dinner. And then I, Jerome Powell, the central of the Federal Reserve, print money and use that to buy back your bond. Now I'm holding the bond, you're holding the same amount of money, and the government has the chicken. Okay. And so the private sector has fewer chickens and there's more money because you have the same amount of money. Well, the government, Uncle Sam has now spent the money that you gave it, the cash, to buy chickens. So there's that money that you originally had, that cash is back in the system. And then I've given you some more cash because I printed it at the Federal Reserve. And so we have more dollars, chasing fewer chickens. That would happen here as well because the Fed would just buy treasury bonds from mutual funds that were marketing treasury bonds. And these would be funds. So that's how open market operations. But the Fed could operate on any of these mutual funds. It could buy not just this particular type of security, but it could buy commercial paper. It could buy stocks if it wanted to support the stock market. It's done a lot of this stuff indirectly through quantitative easing. So it's not like it's not doing this. It's just not doing it in an open way.
There'll always be a need for a lender of last resort, whatever the structure of the financial system seems to me. And your system, your proposal would reduce risks, but there still would exist innovation in the financial system and periodic shocks of one sort or another. Larry, we're at the end of our hour, which went very quickly. Seems to me any one of these topics we could spend a lot of time on, but I want to thank you very much for this opportunity. And I'm reminded of a Chinese phrase, which is, the journey of 1,000,000 miles begins with a single step. So I really think it's wonderful to put forth these ideas. And I completely agree with you that we need bold and innovative thinking to address some of the very, very significant problems that we have. So thank you very much indeed.
Thank you, George. It's been a great pleasure, and happy holidays to you and to everybody else listening.
Thanks very much. Thanks for this opportunity.